Hello, everyone. Today on the final bar, we'll do our normal Friday routine where we wrap the week. We focus on how the markets have evolved from last Friday to this Friday, and I swear we have a lot to talk about looking at the charts this week. Right, you have the S&P with the gap down on Monday, but then retreating and sort of returning back to a bit of an upswing, stalling once again at the 50-day moving average. Big moves as well in interest rates, in cryptocurrencies. We'll hit on all that and more, ladies and gentlemen. This is the final bar. Hey everyone, welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the message that the markets provide back to us. I was taught that if you focus on anything, if you want to understand the market dynamics, focus on price. There's so much to be gained by looking at the price of an asset. It's an aggregation of all of that stuff, the fundamental pictures, the quantitative modeling, the concerns, the possibilities, the potential downside. All of that is baked into price because it aggregates all of that buying power and selling pressure. Where it nets out, that's the price, and you can't restate where things changed hands, right? Where the price has actually occurred at a given moment in time. And when we look at the message of price, thinking about the S&P 500, I would argue we're in a very key moment right here, and particularly going into next week. We've had sort of a little of both. We've had the gap lower, we've had the push to the downside, which suggests with a break below the 50-day moving average that all may not be well in the world of the S&P 500. On the other side, we've seen a nice recovery after the Fed meeting, some fairly accommodative, encouraging words. The S&P bounces a little bit higher. So this could be the beginning of a cyclical led recovery that pushes us to new S&P highs, or could be forming the right shoulder of big head and shoulder pattern before we break down and make new swing lows. We're going to look at all of that and more here during the course of our show today. Great guests on the show. We had a lot of fun this week. Jay Pettit on Wednesday did a great job using Fibonacci extensions, looking at some particular combinations I thought were really, really, really interesting. Next week on the 28th, we have Alessio Retigliano. On Tuesday, he's a cryptocurrency expert at Wyckoff Analytics. On Wednesday, the 29th, Dana Lyons from the Lions Share Report joining us once again. On Thursday, the 30th, Jeff Weiss, who was one of my early mentors in the industry, taught me a great deal about being patient and thinking about the long term trends. It's a perfect time to bring Jeff on the show and put these moves into proper context. Also, next week on the 28th, on Tuesday, 5 p.m. Eastern, we have our latest episode of The Pitch. I will be moderating a fantastic discussion with Tom Boley from Earnings Beats, John Kosar from Asbury Research, Joe Rabel from Rabel Stock Research. It is a stock picking showdown. Each of them get to pitch 5 names. We'll discuss them as a group, and you will leave that event with a list of tickers to think a little bit more about. Go to stockcharts.com/the pitch for more information on that special event. Continuing on with our wrap the week segment, so we think about this market. We're going to look at some of the short term movements today, see how things netted out. It's essentially a choppy flat day for the S&P, which is sort of reasonable. I was talking to my wife earlier over lunch. We talked about a long week with getting the kids in school and everything. We sort of felt like Friday was sort of a nice down reboot kind of day, and that is what the market essentially did with this Friday. Is sort of chop around, netted out a little bit positive, but overall, I think it was more of a mixed sort of a relatively quiet day after a week of excessive volatility. When we look at the markets today, what do we see? S&P just a little bit above zero. The mid caps and small caps just a little bit below zero. The Nasdaq and the Nasdaq Composite literally flat for the day. The VIX, by the way, down a bit below 18 once again. This is down from the mid 20s in the last couple weeks. Elsewhere, some of the biggest movements that we saw this week were in interest rates and in commodities. You have the 10-year yield above 140, actually ending the day around 146. Now, this is up from 110, 115 not too long ago, but it's still below 175, which is where we were at earlier this year. So it's sort of mid-range from where it's been over the course of this year, 2021, but certainly has been increasing. You just see over the last couple of days how we've continued to see weaker bond prices since the Fed meeting and interest rates going higher and higher. And overall, that certainly is a tailwind to The financial sector, the XLF is doing just fine this week and starting to show some renewed strength with charts actually threatening to break above previous swing highs. The dollar index up a little bit, but nothing too crazy. It's still sort of around that 25 level for the UUP. Other asset classes here, commodities overall were positive, although gold and precious metals were down. Silver was the worst of the group that we follow closely. With the SLV down about 1%, gold down around 0.1%. Gold has had a choppy couple days. When we look at the chart of gold, it's more of a chart of long term weakness. We'll get to that if we can here in a moment given the time restraints on Friday here. Finally, cryptocurrencies really coming off in the last 24 hours. You had the news out of China about cryptocurrencies essentially being declared illegal. I'm very much summarizing the news story, but that is the general theme, and that's why you see a gap down overnight or early morning U.S. time here with gold and Ethereum coming down. Ethereum touching or Ether touching 2750 and coming back up to around 2,900. So you've had a lot of volatility in these asset classes, and it's not unexpected that you have the big moves. Stories like that, which really question the longevity or the possibilities of these becoming more widespread and more mainstream, which would certainly suggest that the prices would be much more elevated than where they are here. News like we saw in the last 24 hours certainly puts a weight and is difficult for these things to recover. I think Bitcoin and Ethereum still sort of path of least resistance appearing lower in the short term. Let's look quickly here at a chart of the. Actually, we'll come back to the chart of the S&P 500 because we'll get to it in our Mindful Investor Live chart list. Just want to talk really quick about two things. We'll talk about interest rates, and then we'll talk about Bitcoin and Ether here in a moment. So when you think about interest rates, right, higher rates, lower rates has a lot of different implications for that, and a lot of different things it could be suggesting. I think at the end of the day, focus on the charts and what they're telling you. What the chart has been telling you is that rates were going higher. We were in a rising rate environment through the end of the first quarter. From the beginning of April on, rates have been coming down. The 10-year yield hit a low here around 110, 115 or so. This was in July to early August. From there, we've really seen a bounce higher in rates. And I think this level here, which is around 138, we'll call it 137, was a level of resistance over the last month. Sort of bounced up here, and then we've settled into this range, arguably with the rise that we've seen since the Fed meeting Tuesday into Wednesday, and then Thursday, Friday, seeing the strength or interest rates going higher, seeing bonds sell off quite a bit, certainly suggests we're going back to this previous range. And if you look here, sort of March through June of 2021, we spent a lot of time in the 150 to 175 range. Certainly seems like rates are going back into that potential level. If that's the case, and if we do see that upside, and again, from a technical perspective, I think we've broken out, and I think the path continues higher until proven otherwise. At that point, think about what that means for banks, where that's essentially their business is based on interest rates. Think about what that means for cyclicals overall, growth versus value, all has implications from that chart. One other thing, just very quickly, I was asked about Ethereum, and it's rarely that we look at super short term charts around here, but I will bring one up here very quickly. So, with something like Ethereum, Bitcoin, any of those cryptocurrencies, the challenge is how you make sense of these moves because they're so volatile and they're so short term. So I don't look at a lot of intraday charts on the show or in general because it's too short term of a time frame. But if you really want to understand the price dynamics of something like Ether, you really need to look at short term charts because they move, they trade in the short term. There's a lot of speculation, a lot of money going in and out of these. And I think focusing on those short term dynamics, looking at an hourly chart, even shorter than that, will help you make sense of it. When I look at Ethereum and Bitcoin, they've all sort of, this is the big drop that you saw early morning US time. And you can see it's sort of settled into a range. I have these two ranges sort of highlighted. On the upside, you have about 3,100 to 3,150. That's where we bounced up. Earlier this week, we've sort of traded right back into that range before rolling over. On the downside, we neared the 2,700 level, but didn't quite get there. That was the low from earlier this week as well. We've now settled into this range. So, in some ways, these sorts of charts are incredibly easy because you have a clear level of resistance, a clear level of support. In my opinion, it's now a range bound chart, especially on the hourly chart. And you wait to see which way the momentum breaks. And if we break above 3,150, we break below 2,700. One of those happens, and I think that would indicate the likely future path given that strength and momentum. Long term, though, if you look at the daily chart, the trends in all of those cryptos, I would argue still down until you can continue to show some signs of accumulation. Let's look at how the week played out here, continuing our wrap the week segment. The S&P 500 over the last five trading days. And actually, let me make sure we bring it back one more day here. We need to add day 5. There we go. So we're starting the clock last Friday. We're looking to where we are now. That looks about right. The S&P 500 is here in black, right in the middle, around 0.6%. Let's look at what happened out elsewhere. A lot of things actually underperformed large cap stocks this week. In green, we have the US dollar up 0.1%. Just below the zero line, we have the NASDAQ 100, which is essentially flat for the week. In gold is the GLD, the gold ETF, down 0.3%. In orange, we have emerging markets down 1.2%. In red, we have bond prices down 1.5%. We talked about rates coming higher after the Fed meeting. This is the Fed meeting into Wednesday, and then Thursday, Friday coming off with bond prices. The strongest performer of the group, crude oil, up 3%. I showed that mystery chart yesterday. If you missed it, we talked about how the USO has tripled the returns of the S&P 500. The S&P is up about 18, 19% year to date. Crude oil and the USO ETF up about 50 to 54% over that same time frame year to date. So crude oil prices really have been appreciating. This week is just the latest in a pretty decent run there. Throwing Bitcoin into the mix. And again, let me bring the fifth day in here because we did not have a holiday this week. Here's Bitcoin at the bottom. I usually take that off the first look just because it's usually one of the outlets, an outlier on the upside or the downside. Bitcoin has actually come down about 10% since last Friday overall. So, again, the cryptocurrencies in general tend to be extremes. It's higher volatility, but the implication was something with greater volatility and therefore greater risk should be greater reward. The concern I have with things like Bitcoin and others is that the overall trend, I think, has been rotated more lower. So has a lot to prove before it feels like it's reemerging in a position of strength. We're going to finish off our Wrap the Week segment looking at the Mindful Investor Live chart list. And this is a chart list I maintain on StockCharts.com. You are all welcome to access it. If you've never looked at this before, go to the Articles tab, go to my page, which is called The Mindful Investor. You'll see a button at the top that says Live Chart List. That will get you to this list of charts. You're welcome to save them, share them with your friends, do whatever you like with this set of charts. So we start with a market trend model, which is a systematic trend following model based on weekly data, based on exponential moving averages of that weekly data. The long-term model is based on the 21 and 34 week exponential averages up here in blue and in red. This model turned positive in June of last year and has remained overall very positive. Seems about right to me. The long-term trend undeniably has been positive, with the S&P not too far, about a month removed from its most recent all-time high and bouncing pretty good into the close this week. The medium-term model for me turned negative in May, which has been a bit frustrating, to be honest with you, because the S&P values have gone higher. But what it's reminded me is the fact that so many stocks have deteriorated. When you look at a lot of breadth measures, they peaked in April and they've come down. We looked at banks and energy stocks; they peaked out in April into May. And then June, and then came off and have been underperforming. So a lot of stocks are breaking down. A lot of stocks have broken down and are down fairly significantly from all-time highs earlier in the year. So the medium-term model for me has been negative since May. The short-term model literally is a hair away from turning back positive, but I think I'll have to wait till the closing gun fires and confirm the data at the end. But it looks to me like it's going to remain just slightly negative, which has been negative for the last couple weeks. This is the longest that the short-term model has been negative since last September, which was during this sideways consolidation period that we saw before November of last year when it made new highs. The daily chart of the S&P we look at most days on the show, and so I don't want to revisit this too much, but we talked yesterday in great deal about the warning signs we've talked about, and I think the strength that we've seen going into the end of the week sort of gives you this week is a summary of the overall market conditions. Option one is this rally is the beginning of the next leg higher. You've seen the cyclicals do just fine. Things like industrials appreciating, financials, energy working. Those are all some of the things that could be the sectors that would drive us stronger toward year end if you buy into the bullish through year end thesis, which I don't think is unreasonable at all. For that to sort of be validated, you really need to get back above the previous swing high. You need to continue making new highs, which means you get back above 45.50. I think that gives the all clear after the distribution that we've seen, Friday into Monday of this week. So the bounce higher could absolutely be the beginning of this next leg upwards, and we continue on, and this uptrend that does not stop, literally does not stop. Option B, though, the other alternative that I would pitch to you would be the Head and Shoulders sort of thesis, which means we are forming the right shoulder. Now, it is way too early to be calling this a head and shoulders pattern or a head and shoulders top. That is actually not correct. You really can't call it a valid pattern until you break down through the most recent swing low, break what's called the neckline of that pattern. So you have to connect the low here with the low there, which means the S&P has to go quite a bit down below 4,300 to validate that as a real negative distribution pattern. I think a lot of people probably rely on 4350, which is that close from mid-September. I don't have a huge problem with that either. But overall, you'd have to come down quite a bit, and it's not a head and shoulders pattern until the shoulder is confirmed by breaking lower. So what's interesting is this move this week higher sort of confirms both of those. It makes sense if you're bullish or bearish. The real question is what happens next week. Now, that's within the context of the fact that breadth conditions have remained fairly negative. The cumulative advanced decline lines this week have undercut their lows. All four of them undercut their lows from July and August. Still, only 50% of S&P members above their 50-day moving average. That's down from 92% back in April. So you've had plenty of stocks that, given the opportunity to break down and break support, they have done that. So you'd have to see a material improvement in some of those breadth indicators for me, along with price appreciation, right? Not just a bounce off of a new swing low, but following through and showing that stocks that have rallied this week actually have some staying power, some additional buying power into next week that may confirm that this bearish mood that I'm spreading may be unfounded. We need to take a quick commercial break. We'll be back answering your questions from the Final Bar mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close as we focus on the market dynamics, focus on the charts, try to make sense of things in uncertain times. And again, I feel like there are times when you have to dig for themes because there's just not a lot happening. This week was not one of those. When I'm thinking of how to, what to talk about on a Friday show, trying to summarize this week, there's so many different things we could touch on. So we're hitting on as much as we can. I'd encourage you to check out a lot of the articles on StockCharts.com. I have a great group of contributors that are providing ideas, and many of the other shows on Stock Charts TV really cover the markets, I think, exceptionally well. A couple comments before we get to your questions in the mailbag. Number one, our comments or our questions for the mailbag all come from you, our viewers, and we get a lot of great questions via email, on Twitter, on social media, and elsewhere. As a reminder, questions are always welcome. Email's the best way, which is thefinalbar@stockcharts.com. We're on Twitter at FinalBarSCTV. We're on YouTube. Just go to the Stock Charts channel and put a comment below the video that you're watching. We'd love to hear from you. Feedback on our show is always welcome, but especially questions that are coming up as you are analyzing your own charts. Also, go to StockChartsTV.com. Use your email address. You can set up a free account and start watching all of our great content immediately from the website, also from your mobile devices. You can search on any of the app stores just for Stock Charts TV on demand. Let's continue on today and open up the Final Bar mailbag. I love this part of the show because, again, we receive so many great questions, and we love to take some of them and address them on the air. And again, I think you can learn a lot from having others kind of going through the process of learning charting and technical analysis, how to use stock charts. And I hope we can illuminate some of the questions from all of you here. Question number one. I want to do backtesting using weekly data on Excel, but on stock charts, I only have access to daily data. How can I convert stock charts daily data to weekly data using Excel? Really good question. It's actually a feature that a lot of people probably don't know about. I actually didn't know much about this until I started using stock charts more and more a number of years ago. But if you're looking at any of the sharp charts, just below that, there's this little button you may never have looked at called Past Data. And if you click on that, you can actually get a data table of the data that's on the chart, right? And it's a way to sort of verify the values that you see on the chart. It's a great way to just identify particular levels. If you're thinking about support and resistance, you can download that data set into Excel, which is a great way to use that. And you're able to to use Excel capabilities to do all sorts of crazy stuff with it. What you're asking about is this button right here. If you click on Select Period, you can set the different periods. Now, if you bring data into Excel, there are ways in Excel, and I encourage you to check out the capabilities there to try to filter data and come up with different values. But you can easily download data on different timeframes, but you do have to be a pro level user of StockCharts.com. So the way that StockCharts works is you get a lot of great capabilities on any sort of paid subscription, but from basic to extra to pro, the higher the level is, the more features and benefits that you get. And this is one of those there. We give you a lot more flexibility in terms of the types of data you can access, the length of the chart, the number of indicators, the scans, and all of that. And so, maybe a good opportunity to upgrade to a pro level user if you're going to be downloading a lot of that data may certainly be worth it to help answer those questions. Next question here now. I generally use MACD as my primary screen to identify opportunities, and I look for a MACD crossover below the zero line. What is a good ADX reading for such a screen to ensure that I'm not trading against the trend? How should I be thinking about the positive DMI and the negative DMI? It's a really good question, and this is going to be tough to answer in great detail, just given the limited time that we have on the on the mailbag segment. But there are a couple things I would tell you. So number one, using MACD as a screen is a great idea, and I don't have this chart set up here, but let me bring it up really quick. So if we say like MACD, we'll do the regular MACD. We'll do something like RSI. I'm going to add something like the ADX line with the plus DI and minus DI. This might make the chart a little busier, but I'll explain what I'm doing. So we have price at the top. We have the MACD indicator, which is a classic trend following device. My market trend model is based on exponential moving averages, and that's exactly what Jerry Apple did when he created the MACD indicator decades ago. Was basically taking smoothed out exponential moving averages and looking at the differences between those. He smooths that out with a red signal line, and you're looking at when the level has gone below zero, below that histogram, below the zero line, and turns positive. That's sort of a classic buy signal. You can see a couple times when you've had really low readings and then you've given a buy signal. A lot of times it's ended up being a pretty decent place. I brought this up on EA, by the way, because this is a group and a stock that's been certainly beaten down, bounced a little bit today. You don't have a MACD buy signal yet. That might be something interesting to look for. What's a good ADX reading? So it's a great question. The ADX is actually the derivative of the directional movement indexes, the plus and minus DI. These are indicators designed by Wells Wilder, who also created RSI. He wrote a book whose name completely escapes me. New Concepts in Technical Trading Systems is what I think it's called, but I might be wrong on that. He wrote that in the 1970s, creating a bunch of indicators to trade commodities. He created the RSI, which is widely used now for a lot of asset classes, and he created the ADX and the DI and the DMI, the directional movement index, as a way of tracking the trend. This is a very lagging indicator designed to understand trends. The green line represents, and this is how I summarize the plus and minus DIs. The green line represents the highs. The red line represents the lows, kind of, and I'm totally fudging the math, but that's how I've tended to think of it. When the green crosses up through the red, that's a buy signal showing you the highs are getting higher, the lows are not getting higher, and this is the beginning of a confirmed uptrend. If the red crosses up through the green, that's a confirmed downtrend because the lows are getting lower, the highs are not getting higher, and as a result, it's tracking a downward trend in price. So the ADX line is a derivative of that, and it purely charts the strength of the trend. The higher ADX line does not imply a direction. It doesn't mean like a higher ADX means an uptrend and a low ADX means a downtrend. It just tells you the strength of the trend. And he intended that you use all of these together. You use the green and the red, so in this case, to determine it's a strong downtrend, and the increasing ADX tells you it's a stronger and stronger downtrend that's been playing out. If you look at how these indicators work, the RSI becomes oversold when something's beaten down. I think of that as more of a leading indicator. It's now coming out of the oversold region, which suggests we might be at a bottom. The MACD would probably confirm that second with a cross higher. The DI and negative DI, the positive and negative DI, would probably confirm it last because it lags behind the other things in general. So having said that, a high ADX reading would be an ADX above 20 or 25. That's what's generally considered to be a trending market. Below that is more of a range bound market. But I would encourage you to experiment with the scanning tool and think about how you can use some of those. I would caution you, too many indicators on one chart and you can start finding reasons to do whatever you want. That's called confirmation bias, and avoid it if you can. The last question, then that's all the time we're going to have today for the mailbag. Hey, Dave, I noticed your three trend lines on the S&P 500 have all now been broken. Will you be removing and or updating with a new one? Great question. And it's funny. I was taught by one of my former analysts at Fidelity, Mark Dibble. And if you missed, I interviewed him, which was a lot of fun earlier this year on Behind the Charts, which is our interview style show. We talked to some incredibly successful technical analysts about their craft and how they learned it. I would encourage you to check out the conversation with Mark Dibble on our on-demand platform. It was really really cool. But he taught me many years ago the value of drawing trend lines and then leaving them on there. I used to delete them all the time, and I try to avoid doing that. I try to show you guys clean charts on the show only because I don't want it to be so confusing that it's hard to track what's going on. But for the charts that I use for myself and for my clients and so forth, I really have a lot of lines and a lot of notations on there because for me it's sort of a workbook, right? It's a running commentary between yourself and the chart to help yourself remember what you were thinking. And I vividly remember tracking this uptrend from November, a valid trend line that was broken. We then had a second line that was broken. We then had the tertiary line, which usually is the last one, and it never really braked. And for months and months, that sort of was the tracking of the trend. Since then, we've broken it, and I've found three lines is about it. If I have to draw a fourth one, then that's no longer a great representation of this trend because what it shows you is that the pace has actually slowed. And when my weekly market trend model has gone negative since May, it's because the trajectory coming out of that October, November period to where we were in the second into the third quarter, it's the market's kind of slowed down. It's still going up, but it's not going up as much. The pace has actually slowed down a little bit. Breaking down some of those trend lines, I think visually reminds me of the fact that the pace has slowed down a little bit. So I don't have any new trend lines that I would draw because to be honest with you, I think anything from here, you're just kind of doing a guessing trend line. If that's something I might have just made up that term, but not in my opinion. There may be others that absolutely would draw additional lines, but for me, I think that's it. For me, the 50-day moving average and support and resistance levels have been much more instructive in the last 6 months for me. Great questions, and thank you guys all so much for sending some very thoughtful questions. We have a couple we didn't get to, and I'll make sure we hit those next week. Keep them coming. The final bar at stockcharts.com is the best way to get them our way. We need to wrap this show, folks, and go to the 3 and 3, three charts in 3 minutes. Here we go. Chart number one is the dollar sign TNX. This is the 10-year yield. And again, there are times when I think interest rates are not a huge factor. There are times when it feels like the only thing you need to know. And I would argue this week might be one of those, might be one of the latter. This week was all about the market distributing and that relative to the Fed. I think there are two big opposing forces right now. I think you have the Fed, which is somehow trying to communicate telegraphing the fact that they're going to be less accommodative, but insisting that they're going to continue to be incredibly accommodative, which is an amazing dance that they're managing to do. The market so far is believing it and is bouncing higher after the Fed meeting. So on one side, you have a Fed that continues to insist they can propel the markets higher. I'm fudging their words, but that's I think what I'm hearing. On the other side, you have a market that's overheated, that's overextended, where the breadth has been divergent, where a lot of stocks have come down, where levels have started to be broken. And I think you have a very reasonable expectation for a down move during the seasonally weakest part of the year. That yin and yang, in a lot of ways, the interest rate chart can help you figure out which way that's resolving. And rates going higher with the markets going higher, maybe getting back up into the range that we saw previously is key. Chart number two is Ethereum. We looked at the hourly chart of Ethereum. I'm highlighting this because I rarely show hourly charts. I think they could be helpful with things like cryptocurrencies because the timeframes are so compressed, because the markets are so volatile that the daily chart tells you the longer term time frame. But looking at some intraday time periods can help you make sense of some of these flips during the day, especially something like this that trades 24 hours where you're trying to just make a sense of the trajectory. I think Ethereum or Ether really is settling into a pretty decent range, and I think these shaded areas could give you a good sense of where things may be headed. Finally, this is your friendly public service announcement that at any point in any given market, some stocks are breaking up and some stocks are certainly breaking down. My example today is FedEx, which is broken down through its support level from late January, which also happens to be a 38.2% retracement of the March 2020 low to the May 2021 high. We've broken down through that support. That suggests further downside in store. This is a stock that's been underperforming and a key name that a lot of people think of as a good measure of overall strength, right? If FedEx is delivering a lot of packages, that means that things are probably humming along just fine. A breakdown there, certainly a check overall in the negative column. Folks, that is our show for today and a wrap for this week on the Final Bar. Thanks so much for joining us every weekday after the close as we make sense of these markets using a lot of charts. As a reminder, go to our on-demand platform, stockchartstv.com, to catch up on all of our previous episodes and all of our great interviews. So much wisdom that we're able to share with our guests on this show. For stockcharts.com in Redmond, Washington, have a great weekend. We'll see you on Monday.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.